Welcome back to Chapter 14 in Intermediate Accounting. This is the second of 4 videos. So if you missed the first one where I introduced bonds or talked about bond discounts, then make sure you go back and watch that first so that the rest of this is going to make a lot of sense to you. So I just want to jump in right now and talk about zero coupon bonds. Then we're going to hop into talking about bonds with a premium, and then we'll look at our first example of a long-term note. So zero coupon bonds, when we're talking about coupon, we're kind of talking about this paying interest, what the bond pays in interest. But if it's zero coupon bonds, it pays nothing in interest at all. However, there is going to be a deep discount for the investor. They are going to pay much less than the par value up front. However, the investor, just like all the other bonds, they're going to receive the full par or face value at the date of maturity. So all they're looking for here is that gain from the beginning amount that they paid to how much it matures for. They get no interest in between. So now let's jump into bonds that are sold at a premium. So we are looking at Coaster Kingdom. So on July 1st, 2026, Coaster Kingdom issued a 900,000 10% bond that's dated August 1st. So if we say 900,000, that's $900,000 worth of bonds. Typically bonds are sold at $1,000 each. They've issued 900 of those $1,000 bonds. The 10% means that's how much that Coaster Kingdom is going to pay to the investors, the bond holders, every year. So it'll be 10% of the 900,000. Interest of 45,000 is payable semi-annually, December 31st and June 30th. So with bonds, it's paid twice a year. The interest payments are twice a year. And so that 90,000, 10% of 900,000 is split at 45,000 between the two payment dates. The bonds mature in 5 years on June 30th, 2031. Funtime Inc. purchased the entire bond issue on a date when the market interest rate for bonds of similar risk and maturity is 8%. So that 8% market rate is what they could find elsewhere if they were to invest in other bonds. So for that reason, because Coaster Kingdom in this example is offering 10% and you can only get 8% in the market, Coaster Kingdom gets to sell their bonds at a premium, an amount even higher than the $900,000 par value. So we're going to calculate how much Coaster Kingdom is going to sell these bonds for to Funtime Inc. So first we figure out the present value of the interest. So they're going to be making 10 payments of interest. So it's 5 years, 2 payments each year, 45,000 each time. They're going to be doing that, and they're basing it off 10%. But when we come up with the price of the bond, we are going to use the market rate because the 45,000 was already taken into consideration the 10% interest, the stated interest that's going to be paid. But when we calculate the purchase price for the investors, we are going to use the market rate, which is 8%. We are going to cut that interest rate in half since they make semi-annual payments. So it would really be 4% in June and 4% in December. So we go to the present value of an annuity table. The reason we use the annuity table is annuity means a series of deposits or a series of payments. So there are going to be 10 payments of $45,000. So we go to number of periods 10 on the PVA table. And then we go to 4%, which is half of the market rate. That gives us 8.111. So we multiply 45,000 times that factor to get 364,995. So in reality, they're paying out cash of 450,000, right? 10 payments of 45,000 each. But the present value of that is 364,995, considering the market rate. We do the same exact thing with the principal, except we're going to use just the PV table because it's a one-time payment at maturity. They pay $900,000 one time 5 years from now. But we're going to use the same criteria in order to find the factor on the PV table. So we are going to use the 8% cut in half, so 4%, half of the market rate since it's semi-annual payments. And we're going to use 10 payment periods because that's how often they're paying interest. That's how many times they're making an interest payment. So we get 0.67556. So when we multiply that times $900,000, that gives us $608,000 is the present value of that $900,000. So we add those two present values together that we just calculated, and this is the price of the bonds. It is $973,000. So that is how much Fun Time paid for the bonds from Coaster Kingdom. Now, Fun Time is still only going to get $900,000 5 years from now. But since they're getting 10% when they could only get 8% somewhere else, they have to pay a premium to get that. So basically, they're paying for their interests beforehand, which is kind of silly. All right, so here's the calculation we just did. Now let's look at the journal entry for each side. For the investor, for Fun Time, they are going to show the investment in bonds at the face amount of $900,000. And they're having to pay out cash of $973 as we just calculated, and you see right above. So the difference is the premium on bond investments. So that extra $73,000 is the premium they had to pay. So that is going to be an adjunct asset that we're going to amortize over time. We'll look at that next. For the issuer, for the one for Coaster Kingdom, the one that's in debt to Fun Time, they're just going to do the opposite. They're going to show cash coming in of $973,000, but then they're going to show bonds payable. They owe $900,000 in 5 years. And then that difference, the $73,000, is going to be an adjunct liability that is premium on bonds payable. So you would see on the liability section of the balance sheet, bonds payable $900,000, and right below you would see premium on bonds payable $73,000. So then the carrying value is $973,000. Then we're going to take that $73,000 and we're going to amortize it over the 10 payments. And as we do that, we'll see that liability decrease until ultimately, after 10 payments, it's down to its original face value of $900,000. Now let's look at the amortization of that premium. So we start out with the carrying amount of $973,000. That is that liability plus the adjunct liability, the amount that Fun Time paid to Coaster Kingdom. And then we look over at the cash interest. So the cash interest is based off the maturity amount, that par value of $900,000 times the 10% stated rate, but cut in half because it's going to be paid out in 2 periods. So the $45,000 will be paid out from Coaster Kingdom to Fun Time every 6 months for 10 payment periods. But then we look at that 4% effective interest. That's coming from the market rate of 8% divided by 2 interest payments. So we take the outstanding balance here, the $973, times that 4% effective interest rate, and that gives us $38,920. Now that is what the interest expense is going to be for Coaster Kingdom, and the interest revenue is going to be for Fun Time. So then we take the difference between the cash interest minus the effective interest. The difference, which in this case is $6,080, will then be subtracted from the carrying amount. So we take $973 minus $6,080, and now our new carrying amount is $966,920. And then we just do the same thing every period for 10 years. So, or for 10 payment periods for the 5 years. So then let me just walk through the next one. So then at the next payment, they're going to pay out $45,000, but they're going to multiply 4% times the outstanding amount. So right now on the liabilities section of the balance sheet for Coaster Kingdom, it shows $900,000 bond payable, and now the premium on bonds payable, that adjunct liability, is going to be the $66,920 to have the carrying amount of $966,920. So we take that outstanding amount times the 4% effective rate, and that gives us the effective interest. Again, we take the difference between the cash payment and the effective interest. The difference is going to be decreasing that value of the premium. So we do that every time for 10 payments, and then we have amortized the entire premium by the time we get to that last payment. And that's when Coaster Kingdom is going to pay $900,000 to Funtime Inc. at the end of the 5 years, and then everything will be off of the balance sheet for both of the companies. So now let's talk a little bit about long-term notes. So a long-term note is a written promise to pay a specific amount of money plus interest that is due more than a year in the future. So it's long-term because it's going to be more than a year. And with notes, we know they're more official than just the payables or the receivables, because those are going to be more like invoices. With a note, we're looking at something that's got signatures, it's going to have interest, it's going to have fine print, and we're going to have all of that in this much more official agreement. So this is where a company says we need some funds. So here's the company asking for funds, and then we have an external source, just like we have with bonds. But this time the external source is probably going to be a bank. So they're going to give those funds that are needed to the company that is taking out the note. So we're going to look at the accounting for both sides of this. So it's a notes payable on the borrower side and a notes receivable on the external source that sent them the money. All right, so if a note is issued for cash. So let's say on January 1st, 2026, Coaster Kingdom borrowed $850,000 cash from Pennywise Bank and issued a 3-year $850,000 promissory note. So they're borrowing $850,000 and they're going to pay them back at the end of 3 years. Interest of $51,000 was payable semi-annually on June 30th and December 31st. So we're going to record first just showing that the bank, Pennywise, gave Coaster Kingdom this $850,000. So we are going to, as the borrower, as Coaster Kingdom, they're going to show cash coming in of $850,000, and they're going to create this note payable. And for the lender, they're going to show notes receivable and cash. This is an investment for the bank, and this is how banks make the majority of their money, is giving out different loans and charging high interest on those. So this is the first entry. There's no interest that's going to be recorded at this point because no time has passed. So we're going to see interest recorded as time goes on, but not yet. So now if we look at those interest payments, so we've got on the first interest payment of June 30th, we show interest expense for Coaster Kingdom and cash going out of $51,000. And for the lender, for Pennywise Bank, they're going to show cash coming in of $51,000 and they're going to show interest revenue. So they're going to get to show that interest revenue at every payment period. All right, our last few slides are going to focus on notes exchanged for assets or services. So here we've got January 1st, 2026. Coaster Kingdom purchased a new roller coaster control system from Hughes Barker Corporation by issuing a 12% $850,000 3-year note that requires interest to be paid semi-annually. The system could have been purchased at a cash price of $809,146. The implicit rate of interest is 14%. So really the interest rate, it's like using 14% because we said they're borrowing $850,000 and they're going to pay interest on that amount, but they could have bought the equipment for $809,000. So clearly they're charging them more interest than what they were showing. So for that reason, just like we did with the bonds, we are going to look at how this was calculated. So the $51,000 that is going to be paid based on the $850,000 loan is going to be using the implicit interest rate cut in half because there's 2 payments a year, and that is going to be the 7%, half of 14%, which gives us this factor, and it tells us that the interest payments have a current market value, a present value of $243,094. Then for the principal, it's going to be owed at $850,000. That's going to be 3 years from now, but since it's semi-annual payments, we are going to show it at 6 payment periods, so 3 years, 6 payment periods, and we're using the 7% interest, half of what the implicit rate is. So the present value for that principal would be $566,389. When we add those together, yeah, it comes to the $809,146. So it shows, yes, they are charging us more like 14% interest a year by saying that the loan is for $850 plus interest, even though we could have bought this for $809 if we would have had cash. But that's the thing, if you don't have cash, then a lot of times you're going to have to pay interest and other fees on top of that. So taking all that into consideration and knowing that we could have bought this for less, the roller coaster Coaster Kingdom, they are going to show this machinery, the control system, on their balance sheet at the amount they could have bought it for, the $809.94. Now they owe $850,000, so they're going to show that as their notes payable. But the difference, they're going to show a discount on notes payable. They're going to show that they had to pay extra for this because they had to borrow the money. And then the same thing, except the opposite direction for the company that they're taking the loan out from, that they're buying this control system from. They're going to show the notes receivable for $850, and they're going to show they made revenue of $809.94, and then they're getting a discount on the notes receivable of the difference. So this is what the amortization table would look like for this note for that extra, that discount that they have there. So we start out with the outstanding balance just like we did before. We know the cash interest is actually based on the $850,000, but the effective rate of 14% cut in half because there's semi-annual payments is 7%. We multiply the 7% times the outstanding balance of $809,904. That gives us an actual interest expense of $56,637. The difference between the $51,000 in cash and the effective interest is going to be increasing the value, and we keep doing that just like we did with the discounts, and just the opposite way that we did it with the bonds, with the premiums. But the same process here whenever they have taken out a note, but there was extra charged because of the fact that they had to borrow the money. So I actually took a screenshot of this top line here, and I'm going to show you how it's recorded in a journal entry. And this is going to be the end of the second video, but there's still going to be a couple more for chapter 14. So make sure you subscribe because you don't want to miss out on these videos as we walk through the rest of the chapters of intermediate accounting. So we just took the numbers from above and we just plugged them in. We said, okay, the interest expense is based on the effective interest, so it's $56,637. The cash being paid out is going to be the $51,000. So this is Coaster Kingdom paying the corporation that sold them that control system for the roller coaster. The difference, that increase in balance, is going to be decreasing the discount on notes payable. And then just the opposite entry for, I think it was Hughes Barker that sold them this. So they show the cash coming in of $51,000 and they show the interest revenue at that effective interest rate. But then the difference is the discount on the notes receivable that they're going to be getting rid of over time. So hopefully all of that makes sense. It's a very similar process all throughout, but it's still tricky to get it down. So continue to watch these videos and work through your homework, and hopefully this will help everything to click well.